Right, Sam, this episode of the Living, Working Abroad show, and we're going to reflect on the Halloween budget specifically from the perspective of non-domiciles and how the non-domicile rules can affect you, but it's actually much more wide-ranging, more sweeping than that. We saw on Bonfire Night a bit more of an explosion, just as dramatic as the Halloween budget in the UK, but for all the opposite reasons. So Donald Trump has rolled in with an autocratic, potentially an autocratic government with absolute control of the powers and the seats to set the agenda for his final 4 years as a president of the United States, where he's proposing to abolish big government, to reduce taxes, and to free up business and enterprise for people to invest and grow their business, their property, their savings for them and their family. The exact opposite of what the nanny state socialist agenda of the Labour government in the UK has introduced in the Halloween budget. A government has got no money to invest in infrastructure developments, although that can be a good thing, unless it gets it from taxation or borrowing. Government borrowing in the UK has now been extended and it's already at a record high, and that's all got to be paid back from taxation. But in addition to that, they've taxed some more to pay the bills and to pay for the infrastructure changes that they will do, to increase the overtime in the NHS, to reduce the waiting times, and not to fix the structural problems of the NHS and the UK and the way it works, but to leave it the same but pour more money into it, which is pretty much the recipe of the last 60, 70 years. And this is the future for the UK, and why there's been these dramatic increases in taxes, up to 90% increases in taxes in the current budget. So let's try to dissect that and see in 4 years' time the difference between the changes that we get in the USA from the trumped up Halloween budget compared to a Halloween budget that we got in the UK. There's three things that we're going to look at today. We're going to look at the non-dom stage changes, the inheritance tax changes, and the capital gains tax changes, particularly had the impact on UK taxpayers, UK expats who are either expats in the UK or expats outside the UK, and how that's going to impact you. And there's more than you think. First of all, non-doms at the moment can come into the UK and for 15 years are deemed to be non-domiciled to the UK, and they can just pay taxes on a remittance basis. So it's quite complex rules, but if you've got businesses and investments and dividends and income coming from overseas, then you don't necessarily pay those taxes in the UK. Well, that's all changing. But to be fair, the changes have already been previewed and they've already been brought ahead by the last government, politically incompetent last government that introduced some of the draconian changes that the Labour Party said they're already going to introduce, and that's effectively changing the non-dom residence of taxation. So it's not going to be any worse than it's been proposed, but there are some stings in the tails. So what it means that from April 25, once you've been in the UK for 4 years, you won't any longer be able to enjoy a non-dom status. So you can still come to the UK up to 4 years as a non-dom and not get taxed on your worldwide income. If you're only staying in the UK for 4 years, you can't get a permanent residency, indefinite leave to remain. You can't get citizenship. Whereas if you stay in the UK beyond 5 years, you can become a permanent resident with indefinite leave to remain, and or citizenship as well, to follow straight after that. So the non-dom, if you want to take advantage of the non-dom rules, you can do as an expat on a short-term 4-year contract, which avoid you from any potential tax liability, citizenship rights going forward in the future. Having said that, it doesn't mean that you can't stay. It just means that after 4 years, you'll pay tax and capital gains and income tax and dividend taxes and inheritance taxes on your worldwide assets and capital. And that's the regime going forward. So it's sort of the key points that you need to just bear in mind on that. So when assets are being disposed of or rules are being changed, it will have a big impact for you going forward. There's other considerations to consider as well in terms of changes to inheritance tax rules. Now these are going to have more of an impact on expats because at the moment you're only deemed domicile after you've been tax resident in the UK for 15 out of 19 years, but that's changing quite radically. So the non-dom taxation of income and gains is being reduced, but then that changes after 4 years to UK residence-based taxation. Inheritance tax liabilities then come in. If you've been a tax resident in the UK for 10 out of the last 20 years, you're going to be deemed domicile for inheritance tax, potentially on your worldwide assets as well. If you're non-domicile, you're only liable for inheritance tax in the UK on UK-based assets, which gives you the full access to the 325 allowance on the UK assets only. But with the tightening up of the inheritance tax rules, long-term expats can now be brought into the scope of UK inheritance tax on their worldwide earnings. And this will bring in people with offshore trusts, offshore businesses, international holdings around the world. And so we need to consider what that is. And even in addition to that, in addition to bringing expats in the UK into the non-dom regime, into the inheritance tax regime, don't forget inheritance tax is a flat rate 40% on your worldwide assets and capitals. It also gives them the scope that if you leave, you've got to, they can still, and you return to your home country after a period of living and working abroad in the UK, you'll still be deemed liable to UK inheritance tax up to 10 years after you've left the UK, even if you weren't born in the UK, just that you've lived and worked in the UK for some time. So for more information, guidance on those changes, talk to us at projectpartnership.com. They're going to tighten up calls for evidence as well on these rules regarding non-doms, regarding your income, your dividends and your assets abroad. So that means you'll have to verify where your residence. We're already used to everybody wanting to check your tax number, your residential address, and that collection of information by all tax agents, whether they're investment companies, pension companies, employers, banks, property agents, land registries, all that information, company registrars, all that information is being exchanged through government websites so that they've got the information to hand, and there'll be more calls for evidence where the burden of proof is on the individual to show that they've not got the tax liability. So the way we can manage around that is to follow the rules and make sure that we maybe will pay more tax in the future than you would have done in the past, but you pay the fair amount of tax and make the maximum tax savings for you and for your family. Let's have a bit more of a look at the details around the inheritance tax and what that means for the UK. With non-doms and UK expats being brought into the scope of inheritance tax more, and a UK expat leaving the UK still domicile to the UK potentially, their residence might be more defined, so maybe have to become non-resident more quickly, but it might take up to 10 years. So let's consider what it is. They've frozen the allowance on inheritance tax for another 2 years at 325. That's very generous, unless you've got a £1 million family home, when potentially that takes you right up to the age of inheritance tax payments. If you don't have a private residence in the UK with an individual with a share worth at least £175,000, you don't get the extra £175,000 inheritance tax relief on your personal residence when that's handed over. So those things have been retained, but they've been fixed for longer to the 2030 before the changes come in. So it's worth bearing that in mind, that you can get an estate of £1 million before you're paying in any inheritance tax. And does that affect the man in the ordinary working person in the street? Well, maybe it does, because we're going to have a look at what the pension double whammy impact is going to be. Consider that pension funds are now being brought under the scope of inheritance tax. Okay, pension funds are being brought under the scope of inheritance tax. Now, before, you could have inheritance tax, and it was paid you could buy an annuity when you retire, and the annuity would last your lifetime with guaranteed income, around about 5% of the fund that you've accumulated, and maybe 50% widow's pension when you die on first death. Now, so defined benefit annuity-based pension schemes are already taxed quite heavily. So to be fair, all the changes are being done on the pensions are bringing them into line with people that are on defined benefit pension schemes. What you have been able to do with increasing restrictions over the last 20 years was transfer your pension or create a cash pension fund for yourself that you could do. But even if you transferred that out of the UK, it's still going to be liable to income tax in the country where you are. So all pension funds are subject to UK taxation up to 45% on all the money that's drawn out after the 25% tax-free lump sum. Now, if an expat wants to transfer it outside the EU, then you could transfer it out, but you pay a flat rate 25% tax on transferring that money outside the EU. Now that rule has been abolished or amended, so that any pension transfer out of the UK into a QROPS will automatically get a tax of 25% when it's transferred. So that gives you a restriction or a tax to pay during your lifetime just to transfer your pension fund offshore. So it's becoming more expensive. And don't forget, even though that QROP, that pension has been transferred abroad to another pension scheme, there is a tax registration trail. The pension companies have got the trail. So that fund is now subject to inheritance tax on death. So you pay 25% to transfer it out. You've still got a liability to 40% when you die, and in income taxes when you draw it out in the country in which you draw it out. So the ratcheting up of tax back claim on pension funds is quite dramatic. And the thing is, those people being taxed on their pension funds are not going to complain because they're dead. These are taxes being charged when you die, an extra 40%. So the widow has got no relief, the tax has got to be paid. And any inheritance tax, don't forget, has to be paid within 6 months of death. Otherwise, interest is being applied. The interest rate on late tax payments for inheritance tax, for example, has been increased to 9%. So it's quite a high penalty. At least with a pension fund, you can liquidate them to cash to pay your tax on the tax toll on death, which is slightly easier than having to force sell a family property to raise the cash to pay the inheritance tax bill. So pension transfers out of the UK are not getting you away from necessarily high taxation. You've got potentially 45% tax on a UK pension fund during your lifetime. If you don't draw it out, you've got 40% on death with an inheritance tax. You might say, well, what about if my pension fund's not going to answer that much? I've still got the personal allowance of 325. Don't forget that pensions are now being amalgamated with residential property and your other investments and your business assets, and consider what a pension fund is actually worth. At the end of 2023, pension funds were pension annuity rates were historical high of around about 5%. So to get a £10,000 a year pension, it's a 200,000 it's a £200,000 fund. To get a £20,000 pension, it's a £400,000 fund. So if you've got a £20,000 money purchase scheme that's giving you a £20,000 pension, it's worth 400,000. So it brings the family into inheritance tax straight away, and on first death, not second death, first death. It gets worse because what if you've got a £40,000 pension? You've got 800,000 then of potential inheritance tax relief. So if your personal allowances and your private residential relief means that your £1 million property that you and your spouse share is free of inheritance tax at the moment, potentially with a 40,000 pension, you've got another £1 million that's going to be taxed at 40%. So that's £400,000 of tax that's going to go. Now, before 75, before the budget, that could be paid, and all that money could be left to the estate without inheritance tax or income tax. Over age 75, to be fair, it would have been subject to income taxes, so potentially paying up to 45%. But now it's a flat rate 40% over the existing inheritance tax nil rate band. So even if you're using that for your other investments and assets, the pension fund is in effect, it's going to tip people over the balance, and it's going to mean that lots more people are going to be paying inheritance tax in the years ahead. So it's something to consider for the future. That there's investments plus business assets plus property assets plus your pension fund is all going to add up to a bigger inheritance tax bill, and more people are going to be dragged into it. Consider how you can plan ahead to avoid that tax legally. If you can gift assets to your family, then potentially you can still avoid some inheritance taxes. If you can hold assets in the right way, then potentially you can protect the family from taxes down the generation. Now, it's not to say that they're not changing the rules and trying to increase the disclosures and get more registrations and more evidence to avoid anti-avoidance schemes. We're not talking a PRO Act. We don't talk about tax avoidance. When we're living and working abroad, we're creating family trusts to protect the family's assets for business, property and investments across border and down generations, to avoid the cost and delay of probate, as well as inheritance taxes and capital gains taxes. So consider what you could do and how we could do that to try and save you that additional tax liabilities going forward. And later on in this talk, I'll just go through some of the ways that we can do that. What I want to highlight first, though, is that again, the inheritance tax is going to affect non-DOMs in the UK as well as UK expats living abroad. they're still going to be drawn into this bigger net of inheritance tax. Let's consider capital gains tax as well. Inheritance tax is a capital gains tax when you're dead. Capital gains tax is a capital gains tax when you're alive. So if you're selling assets such as business or shares or investments, then you've got a capital gains tax to pay. And as we predicted on the Living and Working Abroad show, capital gains tax rates have been simplified quite simply. So the higher rates of 18 and 24% for capital gains tax on residential property is now the new base rate for capital gains tax. So any capital gains tax is going to be charged to 18% or 24%. So basically, if you're selling a business or an investment, your capital gain has now gone from 10% to 18%. That's an 80% increase in the tax rate for your disposal of that asset. For high rate taxpayers, it's gone up by only 20% tax, from 20 to 24%. But there's more. If you've invested your time and effort to build up a business, then when you retired and you sold your business, and we're not talking about listed stock market business, so we're talking about working families building a business in their community, and if they can build a business that they can sell, there's potentially on disposal of that business at retirement, they can get up to £10 million with capital gains tax relief. But that's been slashed by 90% to £1 million. So that's going to increase the tax on entrepreneurs selling their business. Is going to increase the tax by 90% on capital gains tax. Not only 90% because on the relief that's dropped down from 10 to 1 million, but in addition, the tax that they pay has gone up from 10 to 18%, so it's gone up by 80%. So it's 80% more tax with 90% lower allowances. So it's quite significant. So someone who sold a business for £10 million in 2023 that they built up during their career would have got capital gains tax relief on that and not paid 10% capital gains tax. So it saved them, it's a £1 million allowance. In 2024-25, that's now shot up. So if you sell a business for 10 million, you're going to get at least 9 million at 18%, which I didn't do my maths before this meeting, but it's around about 1.72 million pounds of capital gains tax extra on that 10 million disposal. So it's an increase of 17% on the tax you're actually going to pay. But you've still got that £1 million allowance at the end of the day. Hello, don't forget that if you sell your business to cash, or if you've got a business on death, that's still subject to inheritance tax. So not only you're getting a lifetime increase in your capital gains on your disposal, that to cash, that disposal to cash asset is then subject to inheritance tax when you die of 40%, which is, we've said that when you now consider and worry about the size of your pension pot being added to your business and your property sales, it's much more likely that much more people will be paying 40% inheritance tax to feed the tax needs of a socialist government that wants to a state-controlled housing benefits, investment and business administration. So this is what we've got to look forward to in the UK going forward. So just to summarise again, if you've got a pension of 20,000, you've got a £400,000 pension fund, which is now going to bring your family into inheritance tax when you die, and it's going to be subject to 40%. So even so now, even with extra diligence, we're not talking about tax evasion or not following the rules, not paying the right amount of tax. But even now, a family can still do the best for the family to protect the capital in the business, in the property, in the investments from tax. So here's a couple of ideas to protect your wealth across border and down generations from excessive UK taxes. First of all, take your pension fund. If you transfer it to a QROPS or any other pension scheme outside the UK to save up to 45% income tax, you'll pay a flat rate of 25% tax. If you join us at the Proact Cyprus office and become a Cyprus tax resident, you can pay a fixed rate of tax on your pension income. You can register your pension in Cyprus and pay a fixed rate of income tax of 5% at a flat rate. So whether you draw 1 million, 10 million or £1,000 from your Cyprus registered pension, as a tax resident, you'll pay 5% tax. So if you've got a £10 million pension fund in the UK and you want to avoid 40% inheritance tax, £4 million, by the way, you could transfer it to Cyprus and you can draw that all out as cash and pay flat rate 5% tax. So straight away you're taking it away from the inheritance tax trap that is in a pension fund where you've got to either pay income tax or inheritance tax. So become a Cyprus tax resident, draw down your whole of your money purchase pension scheme, 5% tax is paid now, but then you've got the cash to make tax-free investments. We are not investment advisors, but for example, if you bought a life insurance bond, that could be a way of making an investment. You can make an investment, gifts to the family, potentially exempt gifts, or you can make other transactions to hold money in a way that protects you from the cost of delay of probate and avoids inheritance taxes down the line. In Cyprus, one of the things that you can do is consider a family trust, and how that works is that you hold the assets inside a family trust to avoid the cost of delay of probate. Now, if you're doing that in the UK, the tax is really is quite high, but if you're doing it in Cyprus, inheritance tax is zero and capital gains tax is zero. So that family trust will avoid the cost and delay of probate. It will avoid squabbling and arguments. It will mean that you'll know exactly where your business is going in the future. So if you don't want to sell the business and pay the capital gains tax and keep the business running as a family business indefinitely within the trust, and it can be managed from that, and the trust can have a board of trustees with a chairman and control dictated by you at the outset, but give them scope to run that for hundreds of years ahead, a bit like the Duke of Marlborough did with his Westminster trust. There's no reason why you can't do that. You may pay some taxes. If you do that in the UK, you could easily pay up to 45% tax on any income or gains at a flat rate on the trust in the UK. But if the trust is tax registered and resident in another jurisdiction, then you pay the taxes there locally, and a Cyprus family trust incurs no additional tax charges for you. There's the additional complications of domicile and the chasing down that they're trying to do of expats. But if you gift and the beneficiaries are your family, then potentially those gifts or to charity or to family become exempt from inheritance tax. But what you have to do is plan ahead. So if you make these arrangements as part of your lifestyle in the long term, then that gives you the scope to protect your family and your business, to protect your widow from having to pay 40% tax on the pension fund on first death, to protect your family that they can invest in your future, and to protect down the generations as well. So it's not just your partner and your children, but it's their children as well that can benefit down the years with the right investments and the right management and the right control. Bright can help you with that. We've been in a EU Cyprus office for 20 years now. So for more information and guidance, you can contact us at proactpartnership.com. If you need help with your UK tax returns or a review of your non-dom status, you can book an advice call with one of our consultants online at proactpartnership.com. Contact us, and we're always available to help you across border and down generations. Expats in the UK, in the Middle East, in Europe, and in Cyprus and the Far East. We look forward to speaking to you soon. Thanks a lot for listening, and we'll speak to you again next time.